One of the big plays that people are talking about in 2023 is the recovery in China. We've already heard from the government that they want now to open up after that COVID squeeze where we saw the zero COVID policy take growth right down to levels not seen in almost 5 decades. So how does the economy regroup, and as traders, how can we take advantage of an opportunity like this? Let's turn to Ron William. And first of all, say Happy New Year. Thanks indeed for joining us. It's great to see you in the studio again.
Thank you. Good to be back in 2023.
So now, you at RW Advisory have put together a whole bunch of slides talking about this reawakening of China. How do you view the opportunity broadly, first of all, before we get into the charts?
So it's an uneven recovery that we're likely to see in the first half, and then longer and more stable second half and beyond. We begin by looking at the vital signs of the reopening, just to see how the evidence-based data unravels. And you can see here on the opening chart, the reality is infection waves have peaked in Tier 1 cities, looking at Beijing, Shanghai and Shenzhen. That was late December. Of course, there are likely going to be short-term challenges as that situation recovers, and that's been the case the world over. But the good sign is immediate rebound in high-frequency measures like mobility data, so the number of passengers in the metro, which is one of the transparent things that we can look at. And you can see there just it being in an uptick situation over the last month or so. All of this along with, so the reopening along with stimulus and policy driven stimulus, it's already in the headline speeches, it is pro-growth and proxy assets. So you can see there the chart at the bottom, figure 3, just showing how both China, MSCI and the resource play of copper, being the biggest buyer of copper, are both up since November. What's interesting is the black line, which is China's stimulus, bottomed in early last year, 2022, where there was a shift into the easing policy, and yet that wasn't strong enough to shift the market into recovery point until the reopening actually happened. So having both together is a positive for the short term.
Let's look in some more detail about some of the asset classes that we're looking at here. I'm interested, you mentioned copper, but there's a lot of asset classes that could contribute to this rebound or benefit from a rebound in China. But also take a look as well at what's happening with China offshore and onshore, because there's a different market there as well, isn't there?
Yes, I think the global picture is more polarized, where different experts are citing plausible scenarios for a strong recovery that could impact the world, or a more lackluster one that might not. I think it's good to play out each scenario, even the ones that we least expect, so at least that way we're prepared. And also, last year, if ever there was one lesson, it was be prepared for the unexpected. But unexpected doesn't just mean negative surprise, it can mean positive, which is one of the reasons why I'm grateful that we're having this discussion, because we're actually looking at the other side of the investment projections and opportunities. So we can see here the best way to look at the best and least best opportunities is by looking at a model-driven approach. This is what I look at on a regular basis at RW Advisory. It's a global ranking model looking at trends across strategic long-term, tactical medium-term, and active short-term. And you can see right at the top there is the resource play led by copper, not oil, I might add. Oil is right at the bottom, so it has had an oversold rally. Everyone can see that on their trading screens, but it is still pressured by the long-term to medium-term trend forces, and it didn't really kind of push up post-geopolitical risk from last year. So we do need to see further directionality to the upside on oil for that to play out. But for now, copper is definitely strong, top. Also fueled by the macro reopening play of China. You can see China there in light green, ebbing up higher, recovering from that oversold condition, nearing the benchmark world performance, you can see their world in purple. We're neck to neck and likely to outperform in due course. So a reason to certainly be neutral China and maybe overweight China over the long term to strategic, depending on everyone's perspective on the market. Now, if we look at the actual hard and fast performance, the charts on the right paint the picture, and you can see top right figure 2, MSCI China outperforms S&P 500 by just around 20%. Now, if we think about that for a moment, this is really where fire meets ice. So we have this upside surprise story from China, which may continue soft or strong, but the key thing is it's there. While the rest of the world is talking about a slowdown and recessionary forces looming, it is an interesting juxtapose, and I think it's important for us to at least differentiate between the two for now, and the fact that there's a plus 20% differential. If we look at the bottom chart, figure 3, it shows more of the same, but for the same region. China up is positive for EM equities, and probably a better way to play the China story through the regional trading partners amid the high correlation, but also potential high beta plays where we can get a better risk reward for this type of theme.
Let's pick up on this point now as well about the onshore and offshore, and ask how steady the recovery is and how you gauge that.
Yes, so the actual broadness of the recovery and the pace are the two things I think where there's most debate. And what the charts show us is that it is an uneven recovery. If we look at, exactly as you said, onshore versus offshore. Now, what do we mean by that? If we look at the well-known and popular proxy CSI 300, which is the relatively new broad index on China, which looks at a mixture of industrial stocks found in the Shanghai composite and the tech-driven ones in the Shenzhen index. So if you diversify your risk, but also look for the best of both worlds, you get the chart there on the left, which, yes, is down over the long-term trend, but it's unwinding from oversold conditions, which is the main story here, as part of that reopening story, and has just broken its falling strategic 200-day moving average. Now, that's an early bullish signal, but not the be-all end-all. We do need further sustainable follow-through. Right now, we're not entirely overbought. It could still extend further, but we're not far from a 3-standard deviation extreme, which in history, you can see there on the bottom chart on the volatility indicator, has led to a healthy unwind. So perhaps we get 2 steps forward, 1 step back, and we have a little bit of a zigzag trajectory in this recovery from oversold conditions. That's onshore. And onshore, from a macro and geopolitical perspective, is supported by leadership policy. Now, I say that because we're all aware of the headlines that some of these China-based stocks are under pressure, certainly internationally, and in the US exchanges as a case in point, of being delisted. So an average day investor or even trader needs to be factoring this in. We don't see it on the chart per se, but we know it's there, that risk factor. Interestingly, the chart seems to be pricing in some type of structural risk, because if you look on the right, figure 2 and 3, starting with figure 2, offshore China at a cliff edge, basically. This multi-year trend which has been up, but it's broken down. We're now retesting the top side of that trend line. If we break above that, that's positive for China overall and suggests a more viable and sustainable recovery. If not, this would be an additional headwind to consider. And then if we strip out tech, which has been great for everyone globally as part of a mega cap growth theme for the last few years, that generally has been unwinding, but China has outperformed. Certainly if we look at the FANG stocks as a case in point, and that's probably not a big surprise now that FANG has dropped so much and been defanged, but still, earlier on, China was outperforming in terms of China tech. Now, if you take that juice out of the chart, you're left with figure 3, which shows a sideways consolidation breakdown, which is also at a make or break retest level. So again, if either one of these charts push back up, that will be more positive for a broad China bull story. If it doesn't, then it'll be an offshore headwind that people need to keep in mind, and that geopolitical macro risk in terms of the international tensions and just changing polarization that's been taking place over the last year or two.
Well, let's dig deeper on some of the technicals and ask you more about how we go about trading this, and in the context of your next chart, which brings us into the currency markets.
Yes, so hard and fast technicals are actually led. If you look at the stock market play, which featured on our model early on, before the COVID reopening, and then more so thereafter, along with the resource proxy of copper. This chart shows the currency, so dollar, China renminbi, reversing against the dollar. So when this chart goes down, it's renminbi outperforming the dollar. Chart on the left, big chart, figure 1, that naturally chimed in round about the time that the dollar topped in terms of the DXY broad index, along with the interim unwind in interest rates, particularly out of the US. So that was the international macro story as to why other currencies outperformed, but China in particular. And on this chart, technically, it had a demand exhaustion signal early on, then a distribution top phase, which was later confirmed below 710, suggesting that we were going to break down below the 7 psychological handle into the 200-day moving average as part of a overdue mean reversion move. Remember, this is China renminbi outperforming the dollar when the chart goes down. We're currently trading there, so this chart is showing the analysis at the time of the analysis. And we're now trading below that 200-day. We're trading around technical fair value, which is around 660, with risk to 667, if you want to be more precise, as to a potential overshoot situation. The cycles suggesting further uptrend or in renminbi, or down in this chart versus the dollar, but that could come under some macro headwinds, of course, based on how China's leadership actually managed their interest rate differential and their balance of payment situation. Of course, that will influence their own currency. And technically, we could get an unwind during that time. But for now, the technicals did prove out early on, and they're saying that most of this move, China renminbi outperformance, has been played out.
What about the figure 2 and figure 3, and how do you read that in the context of where we are?
Yes, so it suggests further renminbi outperformance in the short term, both in time cycle. That's the top chart that we see there, based on the Foundation Study of Cycles, their mathematical model for measuring cycles on this currency, which I use across global cross-asset markets. The bottom right-hand chart is a historical chart just showing the massive pendulum oscillations on the currency, and that the equilibrium area is around 667, or let's say 670 if you want to round up, or even round down to 660. Above or below, that area is the long-term historical fair value area based on the technical chart.
Just wanted to quickly pick up, I don't want to go into too much for the fundamental side of things, but the chart you showed us with the US dollar against the yuan, the offshore renminbi, this is actually, isn't it? To what degree is that dollar weakness? Because we've been following a dollar weakness story. In fact, you and I have spoken about this in other interviews. When you have a currency market trade, of course, there's always strength in one, weakness in the other. We're talking about strength in the Chinese currency against that dollar weakness. How confident are you that this is a China story and not a dollar story?
Great question, and I get asked this regularly by clients and industry colleagues. It's both, and it tends to be a mixture, particularly when you get a triangulation of factors between macro, fundamental, and technicals. Now, technicals is what leads me in terms of the chart read and the behavioral action. Ultimately, it chimed in with the dollar top and the unwind in rates. That was the timing. But that only gave us the early indication that the dollar top was in, softer inflation print, and let's say a slowdown in central bank rate hikes. was happening. It didn't tell us which currencies were going to outperform the most, or how that was going to impact, various opportunities around the world. China certainly did outperform by a significant amount in comparison to other currencies. We also did see it on the G10 fronts in terms of certainly the G3, euro, pound, the yen. Yen is maybe further amplified by the macro policy of yield control and how that has played out. But generally speaking, different currencies played out differently against the dollar. More recently, the dollar index did trigger a new low breakout, so that is further down for the dollar. That hasn't actually yet shown up on this currency trade yet, partly because of China-specific events that are taking place. So it's never a one-way move or a binary correlation. Things do ebb and flow in different ways in different markets.
Let's move back to copper, because this is one of the big stories. Within this China story, there's a lot of pent-up demand we're hearing potentially for this. And in fact, my understanding is, talking to copper traders, that they're expecting copper to go into deficit. I think this is the idea that we're going to get not enough supply with this deluge of demand we're expected to get. Explain more about the copper charts and where you think how you think copper will benefit.
So the price chart shows the behavioral connection between demand and supply forces, and of course this is going to be the debate that goes on for most of this year in terms of how a China reopening will impact either side of that equation. Focusing on the technicals, this shows that it was likely a buy on the rumor, sell after the fact reaction, where copper did surge into the China reopening headline event from late last year, December, into early this year, Jan, going into the Chinese New Year. But it is currently overbought. You can see that DeMark exhaustion signal, the same one I shared with you on the dollar China renminbi chart, at a key interim resistance zone at 430. So price meets momentum exhaustion. And then you can also see there the volatility measure at the bottom showing a 3 standard deviation historical extreme, which more than likely means that we need a welcome respite in the short term. So a good trade before, during, and a little bit after the headline story came out, but likely pausing for now. What's interesting is if you combine that with the cycle trajectory on the top right, figure 2, it shows that we could have a little bit further upside momentum, but it's a 2-stage pattern, short-term up and a medium-term down. This is not going to give directionality calls, but it does give a further overlay in terms of the timing pattern. And then just lastly, the big picture, we need to take a step back and look at the big picture chart. It shows historical peak zones on copper, which many of the traders I'm sure will be watching in terms of key pivot points. And you can see there right at the top, multi-year peak at between 450 and 440. It really matters, of course, which contract you're looking at. So this is HG1, looking at the continuous historical contract of copper. You can translate that to your own proxies accordingly. So that is overhead multi-year resistance that we still have ahead, even if copper were to rally up higher. So this would need to be a commodity bull trend fueled by China and maybe economic recovery in other parts of the world, or maybe just inflation, or a mixture of the two. But the trend needs to continue higher into that zone. And if not, there's the support zone between 320 and 350, just below, if we have that healthy unwind from overbought conditions. The additional point I'd like to make is you talking about demand-supply imbalances. The positioning is also very interesting, because right now there's a build-up in copper positioning. The biggest buyer is China. So I think that is a positive for copper up over the medium to long term. It needs to stay strong And of course, if this China recovery remains stable and sustainable, then we're likely to see it in resource plays like copper, less so energy just because it's coming from a lower base and has further headwind pressures. The chart isn't bullish yet on a medium to long-term basis, but certainly copper has been playing out. There are ETF plays on both China, onshore, offshore, and resources like copper and perhaps other currencies that could be used as a proxy for this story.
Ron, we'll have to leave it there, but thanks indeed for joining us with this look at the China reawakening story. That's Ron William from RW Advisory. And as Ron was saying, you can trade this through a number of China-directed ETFs on our investment platform and indeed on CFDs. You can pick your choice in terms of how you play this, in terms of copper or any other of the commodity plays, or indeed the Chinese yuan.